Hello, Paul.
Good afternoon, Theo. Are you okay?
Oh, yeah, I'm very well. How are you?
I'm good, thanks. I'm good. I'm in a different office today, so apologies. The light is not as good as I would have liked.
No, it's absolutely fine.
We can't all be as pretty as you, Theo. That's what it is, you see.
Actually, it's 40 degrees today, 41 maybe something. We are scared to go outside.
It's pouring down in rain here in Oxfordshire.
Oh, really? Oh, my God.
Yeah.
Okay.
Yeah.
I think you can share your screen. Can you please try it?
Excellent. Well, unless there's anything you've got to add, I'll start for today's
Absolutely.
session. Great to see you. Enjoy your weekend, Theo, and I
You
will speak
too,
to you
Paul.
soon.
Thank you.
All right. Cheers. Thank you for the introduction, Theo. Welcome this afternoon, everybody, to the next in our Admirals webinar series, looking at price action. And in particular, today, what we're going to be talking about is a specific technical setup within markets, how to trade 3-bar breakouts with price action. So 3-bar breakouts is actually a very simple setup, but what I'm going to be doing is sharing with you is how we can use price action and also just my own experience to help you be able to identify better setups than just the normal standard one. So plenty for us to talk about as always today. Remember, we're Admirals, okay, a Forex CFD broker with global presence and local support, licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and allowing the opportunity to engage with markets utilizing both MT4 MT5 platforms. If you have any questions about Admirals, please get in touch with your account representative and they'll be very happy to help guide you. So what are we going to talk about today? Well, not unsurprisingly, we're going to talk a little bit about price action. And I appreciate, we're here on this is a Friday afternoon, normally we're Wednesdays, but it's just summer months. There's always a little bit of shifting of sessions, but nevertheless, it's great to have you all here. And as I said, we'll talk a little bit about price action, but we've covered an awful lot of that already in the series. Ideally, what we're going to be focusing on is what is a 3-bar breakout, all right? Where do we find them? And actually, how do we trade them? And that's the important thing, is because we'll be able to see a setup and then take it away and utilize it within your own maneuvers within the markets. So if we have time at the end, what we'll also do is we'll have a finish and we'll switch across to the live markets and have a look at how those setups are going. And I appreciate that it's always better when you're discussing like a technical setup to see it within live markets and actually how that's playing out in front of you. For those who don't know me, my name's Paul. Traded for many years, traded for hedge funds, traded for clients. Primarily, I like to focus on FX indices and commodities for my own trading. And I tend to be a trend trader for swing and position trades. And I tend to be a reversal trader for sort of shorter term, sort of intraday trades. So for those of you you're just joining us here for the first time because maybe we're doing this on a Friday rather than the normal Wednesday, and you're able to join us. The whole of our ultimate price action guide is really about helping new traders understand and utilize price action in their own trading. Recognize that for new traders, it's very easy to be intimidated by the amount of knowledge required to be able to analyze markets and engage with them effectively and successfully. However, a little bit of education, a little bit of understanding of price action and how candlesticks are formed and actually what they are telling us, then it becomes easy to analyze and understand markets. So mostly Wednesdays, we have been delivering the series and building upon the previous session so that you're educated and informed how to use price action in your own trading. And you can see if you're looking at this for the first time that we've covered an awful lot in just in this particular price action series. There's a huge amount there. As always, I try and basically get across some of the hard skills and some of the soft skills. The hard skills are, like setups, like today, how to trade 3-bar breakouts or engulfing candles, pin bar formations, key reversals, morning star formations, etc. and also combine that, mix that in with some of the soft skills, which sometimes new traders don't really fully understand, don't really sort of recognize the value of them. But I can assure you, someone who's traded for a long time, someone who's worked on trading floors, who basically coaches and mentors traders, the longer you trade, the more those soft skills come into play and actually start to help you develop a sustainable trading business. So lots to do there. The fabulous thing that you will find is that all of those have been recorded and they're all on the Admirals YouTube channel. So if you've missed a few of them, or if you feel that you'd need to go back over a couple just to help cement your own learning, then you'll find them, as I said, all under the YouTube channel, all under the Admirals channel there. So be able to go in there and find them and work your way through them. And there is, as you can see, an awful lot of information that we've been sharing. And as I said, each one just adding and building so that we're just developing a really good overall solid trading plan that allows us to utilize price action to operate in the markets. Part of those soft skills is about ensuring that you have, simple routines in place. Very often, as I said, new traders, they can get a little bit, overwhelmed. They can be a little bit intimidated. So actually having just simple routines, simple checklists can ensure that you're just doing the correct things every time you open up the charts. And what we said was, just to start with, have a very simple routine, namely that step one, whenever you open a chart of anything, whether it be gold, Bitcoin, euro, dollar, doesn't really matter. Step one, what you want to be doing is defining levels of support and resistance within that market. Start with the monthly chart, down to the weekly chart, down to the daily chart. Draw in significant levels of support and resistance. Good thing about the Admirals MT4 and MT5 platforms is that once you've done it once, it will remember those levels. They'll be there, drawn on there. So, once you've done it once, you'll be able to sort of, refer to them, because markets are still traded by humans, even though execution might be increasingly done by algos, still traded by humans, and humans very, we remember those levels. We see those levels. The price is basically defined as significant because prices either bounced off them, or broken through them. Step two is we want to define, is there a trend in place? Remember, I say this every week. Good trends, it probably isn't there. The challenge we have is that markets tend to, if we do find that there has a significant trend in place, what we're looking to do, step three, is to see how does price react at those key support and resistance levels. They might be significant levels, like the horizontal support and resistance ones you've drawn in. It might be things like big round numbers, right? So we've seen even in the last day or so, in euro dollar going to 110. We've seen gold, bouncing off 2000. Okay, these big round numbers, 000 numbers, psychological numbers that markets remember, or it might be a dynamic level of support resistance, something like bouncing off a particular moving average. That's why we call it dynamic, because it's constantly moving. We're trying to identify that is because we want to be identifying areas where we could be a buyer at support, okay, a buyer on pullbacks at support in an uptrend, or a seller of rallies at resistance. Looking for is at step four, is particular price action triggers at those significant levels. Is it things like pin bar, engulfing candle, key reversal, or star fall like that today? And then finally, okay, sometimes traders, especially new traders, are excited. What they're looking to do is just invariably they can't. So just take a look at the volume. I apologize, I set up effectively the storm today at the moment and stuff, whether that is having it as we go. But thank you for those 5 steps are there to help us out with our own particular trading. So what we're also looking to do, what we're looking to achieve is invariably is find that, we start with a big broad definition, okay, a broad range of instruments for us to look at, namely the major pairs, the FX major pairs, okay, namely the dollar index, and then 28 of the other major and minor crosses, a lot of the major global indices, a lot of the major global commodities, equities, and some elements of crypto. And what we're looking at, as I said, is there's quite a broad range there, which might seem a little bit quite a lot for new traders to work with, but actually, as we sort of look to as you develop and you get good records and reviewing your trading, you will find yourself starting to sort of narrow our ways in towards the just basically having a small basket of instruments that you start to focus on a trade, because invariably that's what we're particularly looking at. So that was all a little bit of introduction. Let's talk about trading the 3-bar breakout. As the slide says, it's a common occurrence that many new traders overcomplicate their trading methods. We sometimes think, it can't be that easy. The setup can't be that easy. It must be harder. And then we basically go out to make our engagement experience much more difficult than it actually needs to be. Sometimes what is required is just a very simple setup. That's what's best for us to be able to execute a simple trade plan every time. And today we're going to look at a very simple price action based trade setup that you can add to your own trading. So the 3-bar breakout. As the slide says, it is an immensely simple system. It is ideal for daily and weekly charts because you invariably can take the time to sort of analyze the market in front of you and see how you particularly wish to engage. But the reality is that it can be used on any instruments and any time frames. What's fine is it's best used, as the reversal point at the end of a trend, or after a significant and clear period of consolidation. And this is where, we're sort of adding kind of my own filter, my own focus on how to trade this. Lots of people will just simply trade a 3-bar breakout, which we'll discuss in a moment. But I tend to prefer to see certain particular types of setup, certain particular types of price action that can actually help me in choosing which is the better of the 3-bar breakout. So we'll explain a little bit more of that over the next slide or two. So what is the basic setup that we're looking for in markets? Here we go. Let me just get up the old drawing tool. So a basic long setup, a basic bullish setup. Our entry is very simple. What we're looking to do is we look to take the highest and lowest low of the last 3 candles that have completed. If you wish, you could use more numbers than 3, but I find that 3 work perfectly well, especially on higher time frames. So, what we see is that when the candle is closed, when the candle is effectively closed, if that might be a daily chart, so the end of the day, or the weekly chart, the end of the week, what we're looking for, is to just basically be able to count back, for the 3 candles and identify the range. That's what we're looking for. We're looking to do the range. And this is where I start to sort of focus in terms of particular types of setups. Because what you'll actually find, there are people who will run simple trading algos that will literally trade a 3-bar breakout of every 3 candles that are sustaining their move throughout markets. However, that's not necessarily terribly useful, I don't think, because you could have basically like here, 1 candle, 2 candle, 3 candle. And so actually what happens is the range becomes far too big. The range becomes far too big. What I'm actually looking for to achieve is that we want basically a tight range that price is going to break out of. That is actually where we're looking to have the most success in terms of engaging with that market and trading through that. So what you can probably see here is that, in this particular case, I'm interested here because these 3 candles, they're pretty much, it's a tight range, It's within the range of that particular 1 candle. And also what I'm interested in is that A, we have been in a bit of a downtrend, and B, okay, we're starting to get wicks, okay? We've got wicks to the south side, wicks down, pointing down. So my likelihood is that I'm actually more expecting invariably price to break out of its period of consolidation and then basically move to the north. And that's where I want to position myself to take most advantage of. So this is an example from sort of end of last year in the British pound against the Japanese yen. Effectively the weekly chart here, right? This is the weekly chart, and in this example, we expect a reversal based on price action and the three candles. You know, we can see the price has actually been moving in a downtrend, and as I said, if I was just constantly moving, so let's say 1, 2, 3, you know, what I'd be looking at is, you know, just having the range, okay, the range of the candles just being bigger and bigger and bigger, and especially when you're looking at something like, let's say, a weekly chart, that could just mean that the trade risk involved is just far too big, right? It's just far too big for us to take on. And actually what we're looking and need to do is very look for ends of trend, okay, where there is a possible end of trend. Maybe it's not clear. Maybe the price action isn't giving you an exceptionally clear reversal signal, but we can just even see by the fact of the price action, okay, having just basically moved down strongly, we're now going sideways before we get ready to reverse. That's what we're particularly looking for. So in this particular example, all right, based on the price action, we were looking at invariably having our entry in that like 120.113, which is 10 pips above the high of the range, and a stop loss of 116.72, okay, which is 10 pips beneath the low of the range. So it gives us a trade risk of 441 pips. Now, admittedly, for many people that might be large, but if you're looking on a weekly chart, especially on something like pound against Japanese yen, that is actually, you know, that's not necessarily too dissimilar. Okay, that's not necessarily too out of the normal ballpark. And as I said, whilst I'm going to focus on like weekly and daily chart setups, you will find this set up across all sorts of time frames. And what we'll do is when we switch across to the live charts, we'll have a little look at a couple of instruments and just look for good examples, good ideas where it is set up utilizing just smaller time frames. But for today, I'm just showing you a few weekly and daily setups just to be able to sort of recognize the setup, be able to understand what we are looking for. So as it says there, you know, stop loss. We never trade without a stop loss, all right? We never, you know, that's one of our simple parts of managing risk. That's what we're always looking to achieve. And the stop loss goes 10 points below the other side of the channel formed by the three candles. The stop loss only gets moved, okay, to the low of the trigger bar after the close of the first weak bar of the first bar, as long as we've not been stopped out. What does that actually mean? Well, it's what I generally tend to call an FBS, a first bar stop, and I'll just show you in the next sort of slide what that actually means. Fabulous. So in our example here on the pound against the Japanese yen, price has been in a downtrend, price went sideways, okay? It's taking a pause. As I said earlier, we had our entry 10 pips above the high of the range, our stop loss 10 pips beneath the low of the range. What we see is, you can see here, is that price heads north and it triggers our long entry at 121.13. Because this was on a weekly chart, this is where we're trading this on a weekly chart, at the end of the week, we look to move our stop loss from the initial position here, 116.72, to 10 pips beneath the low of the breakout bar. This is the bar that's breaking us out of that range. So I'll stop at the end of that week for this trading this off a weekly chart. That basically removes that, okay? We are looking to effectively mitigate our risk, take down our overall trade risk. And so in this particular case, our stop loss moved from 119.11 or moved 2, and so our risk is now gone from what was 441 pips to 202 pips, or about 0.45 R. So this, as I said, is what we'd call as like a first bar stop. This is the bar that has triggered us out of the range. When that bar completes, in this case it's a weekly chart, but let's say this was a daily chart, or let's say this was a 15-minute chart, okay, it doesn't matter. It's once you've identified that 3-bar breakout, that tight range, once it breaks out of it, we're looking to effectively, the trigger bar, our stop will move from the other side of the channel to basically beneath the in an uptrend or in an up move to basically beneath the low of the candle. That's a first bar stop. Okay, we're looking to, as I say, mitigate risk wherever possible. So we've seen where we enter. We've seen where our stop loss goes. We see when and where we move our stop loss. So then let's look at the other side. Okay, where is our reward? Okay, we've managed our risk. Let's have a look at where is the reward. In the particular case, profit taking. Our first target, okay? First target is the 162 Fibonacci expansion projection of the channel. And I'll show you how that, if you're not really sure what it is, when we switch across to live charts, I'll show you that. Okay, but that was basically our target. And we take this, okay, you'll take this from the high and the low of the particular channel, of the 3 bars that you're utilizing your movement out of. And that's what we're looking to achieve. And depending upon your own particular risk style, what we'll be looking at doing is either exiting the full position at the 162 expansion, or what you might be able to do, okay, is if you want to try and run the trade as much as you can, well, then you can move your stop to entry once you've hit that target and trail the position every second candle. Okay, that's one way you could actually do. So that if you are someone who prefers to utilize a trailing stop rather than a target, that allows you to do that trailing position every second about once you've hit that first target, okay, of the 162 fib expansion. What you will find is, some traders, like to have different ways to be able to scale out of their positions, right? These days, I tend to be sort of an all-in, all-out kind of guy. My position goes on, my position comes off at my target. But I do recognize that lots of traders like to sort of take to scale out the position. So, what you could do is, if that is your particular style, as I said, is have your initial target there, that initial target, which is the 162 fib projection. But at that, you close half of your position and then basically move the other half to your entry and then variably just target either the 200 or even more preferably the 261 extension, which is more likely to sort of, be up here. That allows you to effectively have a better reward to risk on your actually overall trade setup. So, I've provided a few different alternatives there, right? My general view is, as I said, I like to be all in, all out. So invariably what I'm looking at is that trade will be set up. I have the first bar stop, namely that my stop loss gets moved to beneath or to the other side of the low of the first bar, the bar that triggers me out of that 3-bar breakout, and then I'm looking to effectively hit that target. Okay, that target of the 162 fib projection. That's that's kind of, let's say, the shake and bake. That's the standard. Now, what happens is people want to manage that trade a little bit differently based upon their risk profile, based upon how they look to engage and manage their own trade. Some people like to try and run a trade as much as they possibly can using trailing stops. So maybe like a 2nd bar trailing stop. Or alternatively, some people like myself like to have a target to hit. What I always say is that there's no right or wrong. What's more important is which is the way that you can consistently follow that trade for 20, 50, 100 trades. That's actually what we're really particularly focused on. That is the important element. So, in this particular example, okay, what we saw is that the price having triggered, and we moved our stop, price went sideways, okay, for 2 weeks, and then it actually moved north further enough to hit the target, okay? So you can see here we had the first bar, and then actually what we saw was, we had a couple of little inside bars there, inside pin bars, all right, which are just kind of supporting you, and then invariably we hit our target at 123.63 for 250 pips profit, or about 0.56 R, okay? And that is one of the step backs, or one of the weak spots of this particular trade setup, is that if you are all out at the 162 fib extension, then invariably your reward to risk is not going to be as ideal as many traders would like. However, in this particular example, it was also possible to target either the 200% target, okay, for 125.21 for a total of 408 pips or 0.92 R trade. So is actually good for traders in the sense that you know exactly where you're getting in, you know exactly where you're getting out when you're wrong, you know exactly where your target is. Okay, so as a almost like a mechanical, okay, almost a mechanical setup that you can follow. This is actually quite a simple one. It's a good one where the element of subjectivity comes in. As I said, is basically identifying as part of your analysis just where you get the best 3 bars to break out of. Okay, we would like tight ranges more so than when a trade is and an instrument is in a particular trend. That's what we don't want to, because then invariably the trade risk just becomes too big. Okay, for the price has to move so much further in order to basically to hit your particular target. What we want ideally is a small consolidation, preferably at an area where we suspect there might be a reversal in play. Namely, we've had the expansion, we've had the run. We can see prices going sideways already. In this particular case, we had an inside bar, we had a pin bar rejection candle, didn't we? We had quite strong wicks to the downside. Okay, remember when we've got those wicks to the downside, the higher probability of price moving in the opposite direction, and that's what we saw in that particular example. Excuse me. So, as I was saying earlier, targeting is a matter of risk profile. If you're looking for greater returns, then you have the following options to increase your possible profits. First one, okay, aim for the 261 return. Okay, rather than the 162, you could aim for the 261, and then what you would do is you would trail the stop after the first week and then leave until the trade either plays out for a profit or a loss. One other version you could do is still aim for the 261 return, but trail the stop out after every second bar. You'll cut back and then basically just trail your stop loss as it goes all the way through that. And that is one of the ways you could do. So Karim has said, hello, what are the 3 candlesticks configuration to use? An inside bar with a pin bar. In this particular case, you can see in that case, you have got an inside bar and a pin bar. That is a lovely setup, okay? It doesn't necessarily have to be that, okay? It doesn't necessarily have to be that. But what I'm saying is, once you utilize those price action skills that we've learned, so far in the series, once you see that, in that particular example, you've got a candle followed by a bullish inside bar, followed by a bullish rejection pin bar. That is what gives you more confidence, okay, that this is a good tight 3-bar range that we're likely to break out, and the momentum will take us to our to initially our initial target. So I hope that helps you there. It's a good question, Kareem. Thank you. As I said, for some of you who particularly want to aim for an unlimited return, well, you can just trail the stop every second bar until the trade stops out. So what might happen is, in a particular case, you might just invariably find yourself at the start of a really good long trend and be able to run it and generate a good reward to risk. Or, as I was saying, one of your other options is that you aim for both the 162, okay, the initial target, and then invariably close half the position at 162 and then leave the remainder to run on a trailing stop. So I've given you a couple of little examples there, okay, because I do recognize that some people like to sort of run their trades as much as possible. Others are happy to just hit a target and be gone. So there's a couple of different options. And as I said, targeting is a little bit of a matter of a risk profile. Some people want to just try and run the trade as much as they can. Other people just invariably see the trade, take it, want to be able to almost place the trade, let it run out, play out. Once they've effectively moved their stop loss to the first bar stop, that's where they want to be. Okay, so the only way you will understand this, okay, is to actually to trade this, okay, to trade this very simple setup, and then be able to look and find, okay, ways in which you can identify which is the best way to manage the trade for you. As I said, I like to hit targets. I like to have a target in, and it means that I can almost fire and forget the trade. trade is on, trade is placed, the trade plays out, okay, and it either plays out, for a good win, or it plays out for a loss. That's that's the standard for any trade. That suits my particular personality, but I do recognize people with different experiences, different risk profiles might sort of have a different particular view on that. NFS says, can you take multiple entries? I would define that, okay? As invariably, personally, the way I would be looking at is actually I would just effectively take one entry, but then I might be looking to add to my position. So in particular case, that in itself here, that is a pin bar. Some people would look to break out of that. Some people would look to basically to see that is a bit of a Ross hook, okay? A Ross hook that you could add to. Others might see that is a pin bar, a inside bar pin bar, and would look to add to that as well. So when you talk about multiple entries, that is how I would define it, that you take one entry, okay, but then there might be opportunities for you to add to your trade based upon the price action, based upon things like Ross hooks, which I think we've covered in one of the previous sessions, so that you can actually add that. I wouldn't necessarily be saying that just invariably, sort of just looking to try and take, additional entries just to average down your position size or average down your price, etc. That would not be my particular way of trading. I know some people would look at that. That would not be my way. But that's it's a very good question. Very good question. Thank you. So, before we switch across to the charts, a couple of examples here. Okay, so as I said, I'm just sharing a couple of examples of weekly charts, because the thing about the weekly charts is that you get a chance to see this building up. Okay, it's not something that's going to happen overnight. It's not something that's going to, you're going to need to see it there and be in front of your screens all day, every day. That's not required. It allows you to do a little bit of work at a weekend and almost get ready for it. But it's a good way to start, but I also recognize that some people will want to trade down to much lower time frames. So, the thing about this as a setup is it can work on the weekly chart, it can work on the 5-minute chart. I'm just sharing with you some examples from weekly charts, but once you understand the exact concept, okay, that is what we're particularly interested in. So this was euro against yen. You can see here that euro against yen was in an uptrend, and there will be people who will have particular algos that just effectively trade a breakout of every single third bar breakout. Whereas, as I said, for me, that's not the way to do it. What I'm looking to do is to basically identify a trend. Identify a trend is starting to stall, okay? It's starting to stall. Sometimes, a trend will reverse and it will give you the most beautiful, clear price action to indicate that is going to occur, and that's fabulous. That's what we would always love that. But the reality is, what you want and what you get can sometimes be very different. And so this is about you having a way and a means to enter the reversal of a trend when the price action is perhaps not as clear cut as you would particularly like. So euro yen was in an uptrend. Then what we see is it starts to consolidate. Okay, it starts to consolidate. This is once we see it consolidating, this is when we're starting to get interested and thinking, well, hang on a minute, this could be a possible 3-bar breakout reversal. And what we actually get is that invariably the short trade triggers 132.41. Stop loss is at 134.22, which is 181 pips. If you're used to trading 5-minute charts, okay, where your stop loss might be 18 pips, all right, as opposed to 181 pips, you might sort of that might sort of make you a little bit of a little bit wary. But remember, it's all about the context, okay? It is all about understanding where you're actually operating. 181 pips off the weekly chart, as your trade risk, it's still 1 hour, it's still 1 unit of risk, okay? And what we find is we actually have the trade triggers, and it hits its T1, that kind of 161, 162 fib extension target very, very quickly, okay? Very quickly indeed, right? Which gave us that 96 pips. What we're also able to do is basically move our first bar stop, all right, which was moved. So we're effectively reducing our risk. We've already taken part of it. And the trade hits the second target, T2, the 261 fib extension, okay, at 129.74 for 267 pips. So, this might be the way that actually traders look to start to work in it, okay, just identifying the setup, just being able to put the trade on, okay, having a portion of their trade come out at the 161, 162 fib expansion, and then the second target at the 261 as well. I said if traders want to be able to sort of fire and forget a trade, to actually basically set and forget, that is a very simple way that you can operate in that particular way. Asking, does it work in smaller time frames as well? 1 hour, 30, 15? Yes, it does. Okay, yes, it does. I like to use this particularly on sort of swing trading, but yeah, absolutely. What you'll find is that the underlying concept works well across all time frames and all instruments, and hopefully people would have seen that the kind of the concepts and the trade setups that I've shared across this whole trading guide. Whilst I might be focused on them, how I use them in my own trading, they are ideas and concepts that you can use across any time frame and any instrument. Okay, some they might work better. Okay, on some particularly you want to do a little bit of back testing, but then you'd also want to be doing forward testing as well. All right, but absolutely the setup, if you think about it, it can work across all time frames because it's just effectively playing out kind of a fractal basis in terms of price. Price is in a trend. Price starts to consolidate. Okay, it doesn't. If you look at this, these couple of candles here, that perhaps is not very, very clear that it's going to reverse. It's consolidation, but once we start to see wicks to the upside and we're triggered in, bang, we're pretty much straight to the entry, and actually only a couple of weeks later, we hit the T2 as well. But that, as I said, that is a weekly chart. But if you just look at that price action could be a 5-minute chart. Okay, it could be a 5-minute chart. Okay, the price is fractal in that sense. What I say is that for new traders, it might be easier to start on the higher time frames because you can take a little bit of time. You don't have to be sat there watching every sort of 5-minute candle. Okay, you can just basically take a little bit of time to identify it, recognize it, work out where your entry is, work out where your stop loss is, work out where your particular target would be, and take a little bit of time to sort of understand and grasp the actual overall setup. And then perhaps as you get confident in it, and you start to work out, your trade management, which particular way suits your personal risk profile, well, then maybe you're able to sort of operate on lower timeframes where things are happening at a faster rate of knots. Example here, okay, the dollar against the Canadian dollar here. Well, as I said, weekly charts. Hopefully you can see that the price has been in a downtrend, hasn't it? Been in a downtrend, and what we start to see is that price starts to consolidate, doesn't it? Price, you can see that not only is it consolidating, we're getting inside bars, we're getting doji candles, which is indecision. Okay, so we are combining the fact that end of a trend, start to consolidate. Price action is starting to give us a place that it's indecision. Okay, there's an opportunity that this is going to turn. All right, that this is likely, that downtrend is likely over, and then invariably, there's an opportunity for us to step into what might be the new trend, what might be just a significant retrace. Okay, and we can see here, all right, in that particular case, it sets up as a possible 3-bar breakout reversal long. Okay, the long trade triggers 121.50 for stop loss beneath the lows, 10 pips beneath the lows there. Okay, so at 1996, you can see that. So our unit of risk, is 158 pips. You can see here, the actual trade triggers here. This is the candle here. This is our trade. This is our trigger trade, isn't it? It triggers our way through. Okay, but it closes right down by the entry, but it's still bullish. What do we do? Okay, we have that's the first bar stop. So our stop loss moves from there to beneath the low, okay, to beneath the low. That's that is our first bar stop, okay. And what we actually see is that invariably the trade triggers. It hits the 161 target. It actually also in the same week hits the 261 target as well. If you're having a excuse me, a second target, and that hits it there in that one particular week. So what we're looking for is markets will consolidate. Okay, markets will consolidate and then they will expand. And that's what we're looking for, the consolidation before the expansion. And we're looking at this as a way, just using 3 bars, price action, consolidation after the end of a trend, to give us an opportunity to be position ourselves for the next expansion. Okay, and to be looking at it to how we want to do and stuff is actually to work out how we're going to expand out of there. Okay, so hopefully that kind of makes a little bit more sense to you. So asking, do you only consider inside bar the body of the wicks as well? Sorry for silly questions. It's my first time attending a webinar. They're not silly questions. As I say every week, we are very, very happy here. Okay, far sooner have questions that actually can help and answer, make sure everyone's got a very clear idea on the actual sort of the trade setup. What you will see is that I do consider the wicks, and I do also consider the price action. So in an ideal world, what I would like to be seeing is invariably that the price has been in a trend, price is now starting to go sideways, and within that sideways block, I'm just looking at the three last candles, looking at what is the price action there. Is there, like in this particular case, dojis that I've got indecision? Maybe there's inside bars, so we're actually getting even tighter consolidation before we expand, or maybe there's rejection candles, things like a pin bar, an engulfing candle. So let me just clear this whilst we've got this particular chart here. I would be very interested here, okay, because basically price has moved, it's pulled back. Then we've got 3 candles there where they're quite close together. All right, so it's as close as can be. You can see hopefully yourself there's lots of wicks. All right, lots of wicks to the downside before we moved. Okay, before we moved. Now that is probably a little bit of a pullback, okay, on the trend down. What I'm suggesting is normally to start with just be looking at at the end of trends, see how it consolidates and how you can particularly utilise. So Kareem says, so the 3 bar setup, is a reversal setup. Yes, it is. That's what we are. That's what we are looking at. Okay. Now, as I said, some people use algos to just basically, they would say 1 bar, 2 bar, 3 bar, and then trade the breakout of that. But for me, that those 3 candles that range is just too big. The trade risk is huge, and if the trade risk is huge, that means the price has to move even further in order to achieve my particular targets. Hence why what I find is that after a good move, we tend to get a period of consolidation. Right, price expands, price surges, it rests, and then it surges again. You're getting basically expansion, consolidation, right, expansion, retrace, expansion. So I appreciate that's getting a little bit. What we're looking to do, of course, is to just try and basically capture, when it breaks out, that first little breakout. That's what we're looking to see there. So we've got a couple of minutes left, so hopefully we can have a little look at the live market. So just remember that. In conclusion, many traders overcomplicate their trading methods, and that often leads to poor execution, which tends to lead to suboptimal returns. Often, very simplest approaches are the best, especially for new traders. It's better to have a fair plan that you can execute well, rather than a very complicated plan, which is executed purely. The 3 bar breakout is in itself a simple setup, but ideally, what we're looking for is as a reversal at the end of a trend, or a period of consolidation. And my personal experience is working well on longer time frames. But what you will find is that particular pattern, all right, it will work well across the across the board there. So Kareem said, would you organise a webinar on how to automate one's trading, creating expert advisors, subjects like this? That might well be a future session, Kareem. Okay. This series is really looking at price action. Okay, that's what we're focusing on. That's the area of it. But it is absolutely right that we might look at how we could do some automated trading setups in the future. So yeah, we'll take that. We'll take that on board. That's thanks for the input, Kareem. So before we move across to the live charts, just don't forget to join us next time. So there will be no price action session next Wednesday. Okay, as my colleague Jens will be covering the webinars next week. So our next price action session will be Wednesday, 26th of July, session 43. And what I'm going to talk about there is the soft skills, how to trade and best use our time during the summer months. Okay, we're very often summer months, the prices, the markets tend to quieten down as people sort of take their breaks and holidays. Well, how can we utilize that time? Okay, why are we interested in those seasonal markets? How do markets change during those summer months? How can we best make use of that particular time? So that'll be 2:00 London time, Wednesday, 26th of July. Check your inbox for the webinar link or head over to the Admirals website and you'll be able to do that. George says, do you consider volume in any way to set the bars? I don't, okay? I don't, primarily because I tend to focus on FX markets. So I tend not to focus on volume. That is not to say that you couldn't, especially if you were trading this setup on, let's say, something like equities, where there is really good volume data that you can actually access. That might well be a filter that you could add. Okay, a filter that you can. But generally, for me, 3-bar breakout, the whole idea is to keep it simple as possible. A trend, consolidation, price action. Get ready for the reversal. Position ourselves, okay, and look to take the trade, okay. Let's keep it nice and simple, all right. Let's not overcomplicate it. But I do take on board, if you were trading, especially equities, being able to sort of have access to the volume data might be something you want to take on board and utilize to help. So if you've got any comments or feedback, okay, you can contact there. The email address is on there. You'll probably get a feedback form after this. So I apologize. I said the internet connection and sound wasn't so great at the start, and I do apologize that we're at the mercy of the weather and the internet gods and the lighting gods, it would appear, as well today. But hopefully, you can sort of understand what we have been talking about here. So as I said, we've got a minute or two. I'll just, if you bear with us, what we'll do is we'll switch across to the chart and see if we can just have a little look at what's been going on there at the moment. So just bear with us. Okay, so here we have this is my profile. This is my euro profile. Okay, see here, it's just the one that's come up. When I look at these charts, okay, so if I just we've had some great moves there in euro dollar and stuff, and quite a lot of the other charts that I trade. So hi there, apologies. I seem to have had just a little bit of the internet connection's been a little bit fragile, hasn't it, today and stuff? So apologize for that. I'm hoping you can still hear and see me. What I was just saying is that because of practice, okay, you start to be able to see invariably when we see the price start to turn, okay, and that might be giving us an opportunity. So my eyes are immediately drawn to when I see these three candles here, which, because I also know that that's the start of a full bar turnaround, okay, a morning star formation. But what we have is there's effectively three candles there, okay, after a little bit of a trend move. Some people might even look at that and say, well, Paul, you've got three candles there in very close consolidation. There's basically the final candle is telling you where it wants to be. Okay, it's a very bullish candle there. And as I said, what we're looking for is, look for moves, trends, and then start to look at, well, hang on a minute, okay, where are we getting our three candles, okay, where price is starting to consolidate, okay, that one we have. But of course, this third candle is a very big candle, okay. Now, of course, it's a very strong bearish candle, but we're looking at, well, does it have the space to sort of maneuver down there to basically be able to achieve the the targeting we're looking at. So what I would be looking at here is just that bang. That is there's our 3 bars. Okay, and if I start to look at, well, all right, I'm looking at the range there. Does the range mix it? Here we go. So I'm just very quickly there, just drawing on my fibs, and then I have here. Let me just pull this in so we can see it. Bang. There is the 161 fib expansion levels, and actually we can see the price does maneuver here. Okay, you've got your first breakout candle, you get the first bar stop, and then price actually does move down to then. But if you're using the 261 target, it's not able to move there. And actually, and this is a little bit more advanced, is that actually once we can see is that here we go, is that price reverses there, but then actually price starts to consolidate there, doesn't it? Price starts to consolidate there. The price action here, okay, starts to get interesting, but I think that you might just actually, if you're not stopped out, well, then you could move up there. But what we're looking at is, once price has made a move, okay, on the weekly chart, start to look at once price starts to consolidate, look at the wicks, okay? That's invariably, markets are like humans in the sense that we surge, we rest, we surge. That's what we're looking for, okay? That is what you're particularly looking for, ladies and gentlemen. Surge, the rest, the surge. And does the rest give you the opportunity to look at the price action, to see, well, does it look like it is reversing? Sometimes, as I said, it's very clear, other times it's not, because that might be the opportunity, as I said, to position yourself into that trade. And when you're operating on weekly charts, daily charts, 4-hour charts, you have the time to basically do that analysis and set that trade up. Yes, you could use it on the 5-minute charts, but you'd need to know exactly what you're doing. Okay, you'd need to be very quick to be able to operate, which means you'd need to under your belt. Okay, ladies and gentlemen, apologies that, unfortunately we've run out of time there. So as I said, I apologize that our internet connection was a little fragile today. So I do apologize for that. The internet gods were not shining on us there, but hopefully you'll be able to sort of get an understanding of the actual overall setup. What we'll do is we'll have a look at that recording. If the recording isn't as great, what I'll do is I'll redo it again. But one way or another, we will have that recording in the Admirals YouTube channel to be able to sort of go through and check it and identify and just take it away and start to look at a couple of your favorite instruments, look at them on the weekly to daily charts. After the price had made a move, did it start to consolidate? Did it start to look like it was turning around? And was a 3-bar breakout reversal trade just a simple way for you to basically position yourself for the next expansion, for the next move? As always, as I said, there won't be any price action section next week, but we will be back the week after. As always, I wish you the best of success with your own trading, ladies and gentlemen, and I will look forward to speaking to you soon. Trade well, everybody. Have a great trading, the rest of a great trading week and month. Cheers.